Tonight, we're going to be talking about some things that I find fascinating, building wealth. Now, there's many ways to build wealth, and we're going to kind of hyper-focus on some things that we can do here at the bank. But hopefully we can build on these classes and we can all learn together. So, and a little bit about me. I've been with the bank now for, this year we'll be going on 8 years with the bank, and I've been in the financial services industry for going on 12 years now. So I discovered my passion for it. I actually started studying here at SUU in the engineering program, and then I quickly found out that I love numbers a little bit more, and got into the banking industry kind of by accident. And I fell in love with economics. I fell in love with the markets, and that's what's led me to where I'm at right now. And today I serve as I am the Director of Financial Services and Wealth Management here at the bank, and I also have a book of clients that I help with financial planning as well. So wealth building class tonight. What I'm hoping to do is to kind of start with the foundation. So we're going to talk about some kind of the boring things, probably some stuff that you've already heard before, but this is the foundation, and then we'll go from there, and we'll get into some of the fun things after we get through the foundation. And I have a rule. When I have a client come in and meet with me, and we talk about their financial goals, one of the first things that I establish from the very beginning is that there's a rule that I have, and I got this rule from reading a book called The Psychology of Money by Morgan Housel. He has a lot of books. There's a lot of financial authors out there, but he's one of my favorites, so I highly recommend that book if you want to. It's an interesting read about money and psychology, how it interacts. But he makes a statement in his book, and he says, never risk what you have and need for what you don't have and don't need. Now that might be counterintuitive to wealth building because it's necessary to take risks. But you'll see why very soon when I say it's important to make calculated risks and risks that you can afford to take. Because if you can't, then the consequences can be catastrophic. So, foundation, let's keep building on it. I have a question for you. What is your most valuable asset?
House.
House?
Yeah.
Anything else?
Time.
Time?
Your income.
Who said income? That's the answer I'm looking for. That's the first time anyone's ever said that. So good job. Your income over your lifetime, your cash flow for you personally, whether that's from self-employment, whether it's from a W-2 statement from an employer, I don't care. That income and that cash flow is your most powerful wealth building tool that you have. And tonight is not about insurance, but at the foundation of any financial plan, any wealth building strategy, is the protection of your asset. And if you look at your lifetime income, which, let me just put some numbers to this. If the average American makes $50,000 to $55,000 a year, and you have a 30-year career, that's a little over or a little under $1.5 million, okay, over that 30-year period. And you look at anything that maybe you've purchased or owned, and that income typically is going to be your most valuable asset you have. Now your home is probably the single most large one-time expense that you're going to make in your lifetime, and it is an appreciating asset as well. So it is an important part of your financial plan and building wealth, but it's only one of the pieces, okay? So with any asset, just like your home or your car or your life, insurance is a way to transfer risk. And we have two options. We can either self-insure if we have our own liquid cash and assets that can be converted to cash, we can either self-insure, which is expensive, or we can partner with an insurance company to help transfer some of that risk. That's not solely on us, but the help of an insurance company. So I don't want to get into too much of this because that's just a piece of the pie, but just know we're building up from this foundation, and protection of your assets is vital. So money management is not just about accumulating wealth, but about mastering the art of balancing needs and desires, investing wisely, and securing a prosperous future. It's really just a fancy way of saying live within your means, save and invest the rest. That's really what it comes down to. Okay? And again, a foundational principle, budgeting. What's the amount of income you have coming in every single month? What's the amount of expenses that you have? What do you have left over? And how do you allocate those dollars to build your future? So I don't care how you keep that budget. If it's a piece of paper, if it's an Excel spreadsheet, if it's a budgeting app, there's lots out there. I like budgeting apps. I like technology and syncing with your bank account and your credit cards and any of your other investment assets. Some of these tools can be used to help streamline and automate some of this, but I can't stress enough that budgeting is extremely important. It's a little harder to control how much income we have coming in, but the thing that you can control the most is what goes out the door. Okay?
Just curious, can you recommend a budgeting app that you have used and liked?
Yes, Mint. Mint is a pretty good one. Do we have anything at the bank? We do on our financial services site. AdviceWorks. If you have interest in it, you can create a profile and you can track all of your different kind of investment accounts, your bank accounts. You can manually enter even real property assets, and you can get a snapshot of your overall wealth. And there's a really cool budgeting app which will link to all of your accounts and help. You can set a budget. So if you have interest in that after, I'll give you my card, and it's by invitation only right now, so we can send you an invitation to that. Won't cost you anything. So we can offer that to you for free. Any other questions or comments? Okay, so once you know what your monthly expenses are, what your monthly income is, there's three things that I want you to focus on. Anybody here heard the name Dave Ramsey? There's quite a few things that I like that he says. There's some things I disagree with. We won't go into those. Some of the things that I agree with is my favorite phrase that he coins is live like no one else now so that later you can live like no one else. Okay, so what that means, your budget, you might be living like a church mouse right now, and you're saving and investing all this money so that later you have all this money, no debt, and you can live like no one else because you can live like how you want. Okay, I really, really like that. And I believe that's one of the best ways to build wealth. Okay, there are instances where you can win the lottery, but the chances of getting rich quick, there's usually some kind of a scam with it, and those opportunities are very, very rare. Okay, so one of the first things that I would recommend that you do as you figure out your budget, the first thing you do before you invest any dollars in the market or anywhere, real estate or anything, I would say your first goal should be to have an emergency savings. And that needs to be at least 3 months worth of expenses. And that's everything. Everything you spend on rent or mortgage, insurance, cell phones, food, gas, whatever you spend on an average month, calculate that up, have that at least for 3 months. Once you have that bucket, you set that aside somewhere safe. Money market account here at the bank or any of the other financial institutions is a great way. It's a higher interest bearing account, but it's liquid and it's safe and you don't have to worry about it and it's there when you need it. Okay? I would agree with Dave Ramsey on this. Do not invest 1 cent until you have that. Because it's not a matter of if an emergency is going to come, it's a matter of when. Okay? Once you have 3 months, then your other accounts that you're investing will eventually get up to 12 months. And when I ask, how do you define wealth? How would you say that? How do you define wealth? Anyone care to comment on that? I can share how I define it. How I define wealth is I want to be able to do what I want with who I want for as long as I want. And you talk about having 12 months worth of expenses saved. What does that actually mean? That means for at least 12 months, I can do whatever I want for 12 months. Now, if you can get that to 2 years, 5 years, 10 years, 15, 30, 20, that's what true financial freedom is. You don't have to go into a 9-to-5 job anymore. You can choose to use your own capital to invest in ways that are going to return and give you money and invest how you want. Okay? But how do you know you're on track? So we've created a budget. We have our 3 months worth of savings. Now what? How do we measure wealth? How do we know we're on track? One of the best ways to define wealth is your net worth. And it's a very simple calculation. You have your assets minus your liabilities, and as long as it's positive, you're in the right direction. And this is where I say, is that enough? You know? And we also have to have a discussion about what are assets and what are liabilities. So name off a couple of assets. We've already mentioned one: house, car, investments, okay. Business owners, cash, definitely. Stocks, bonds, what? Gold?
Yeah.
Yes. Commodities? Yes. Were you gonna say something? Okay. So, assets are anything that can be turned into currency, turned into cash. Some assets are very liquid, meaning you can convert those to cash, like stocks. You can go on an exchange and you can sell a stock immediately and turn it in for cash. A house is a little bit harder, it takes a little bit longer. Unless you have a cash buyer ready to go, it can take months. In some cases, it can take years to sell. So not all assets are created equal, and how quick you can get access to the capital and the cash underlying value, you have to be careful, right? Because you can be land rich, real estate rich, but you can be cash poor. Okay? Liabilities. What are liabilities? Name them off. Expenses. Credit cards. Mortgage, yeah. If you owe money to someone, that is a liability. And in this calculation, the thing that will build wealth faster is liabilities. If you can remove liabilities, then your net worth is going to grow way faster. Okay? Now, maybe in future classes we'll talk about how to leverage, but we're not going to talk about that tonight. So why do we invest? These are three topics that I specifically want to go into. the rule of 72, compounding interest, and the time value of money. We're going to start at the bottom. The time value of money. So, time value of money says that the prices of goods and services that we go out and buy and use are going to rise over time. Now, why is that important? If you take your dollars and put them in a savings account and it's making 0.2% interest on an annualized basis, is that keeping up with inflation? Inflation's been all over the news for the past 2 years, 2.5 years. In 2021, it peaked out at over 9.5% on an annualized basis. So what does that mean? If you had $100 January 1 of 2021, and you had that same $100 and it didn't earn 9.5% that year, it means your $100 can purchase 9.5% less of products and services that year. Okay? So, time value of money is important because it's the hidden inflation, it's the hidden tax that we all pay. And if our dollars are stagnant, then the purchasing power of those dollars diminishes over time. Unless you're putting them back to work and earning interest so that it's growing at least at the pace of inflation, hopefully more. That's the goal. And that's the only way we're going to be able to become financially free, because even if we get to our millions of dollars in our investment accounts, they're subject to inflationary costs as time continues on. So those dollars need to keep earning more dollars as well. Otherwise, it becomes extremely difficult, not impossible, but extremely difficult to save just in a traditional savings account your way to financial freedom. I don't know of anyone that has been able to successfully do that. Unless you want to eat ramen noodles and macaroni and cheese the rest of your life. If that's your definition of wealth, then it works. It's not my definition of wealth. Time value of money. Any questions before we move on? Okay. Compounding interest. Was it Albert Einstein that says this is the 8th wonder of the world? Compounding interest. Why is it important to you? Imagine a snowball running down a hill. As it runs down the hill, it gets bigger and bigger and bigger. That's what compounding interest does for your money. It grows it. And what we love to see is when your money makes interest, and then your interest makes interest, and that just continues on. And it turns into this big snowball, and it can work for you, or it can work against you. If you have more liabilities, credit card companies and the other financial institutions that are borrowing your money, they are taking advantage of compounding interest. So you want it to work for you. You can do the same thing the bank does. And we'll talk about ways that we can do that. All right, this last topic, the rule of 72. The rule of 72 tells you how frequently your money can double. And the reason why that is important is because the more frequently your money doubles, the more wealth you have. And the more that compounding interest can work for you. So, if I'm making 1% per year on my annual rate of return over 12 months, it's going to take me 72 years to double my money. So if I invested $100 and made 1% per year, it's going to take 72 years before I have $200. But if I make 10%, it only takes me 7.2 years. Okay, so the higher rate of return that you can make on your money, the quicker it's going to double. And the more that it doubles, the happier we are going to be. So to demonstrate this, would you rather have $1 million today, right now, or a penny doubled for the next 30 days? Penny, why?
Because it's going to grow exponentially.
Yes. I should have probably had that graph to demonstrate it, but $1 million versus today, but if you take a penny doubled every day for the next 30 days, it's like $5.4 million in 30 days. So, and then also to further demonstrate this, Warren Buffett. Who's heard of Warren Buffett? Okay. Probably one of the most famous stock market investors of our time.
For Nancy Pelosi.
Yeah.
So Warren Buffett was able to purchase his first stock when he was 10 years old. Now, the average American starts investing when they're 25. Okay, so we all know Warren Buffett is worth hundreds of billions of dollars today. Take all of his portfolio and you were able to liquidate it all, you'd have hundreds of billions of dollars. If he had started at 25 and made the exact same purchases, exact same trades that he did when he was 10 years old and on, just that little bit of extra time, he would have only had a couple hundred million. Now, that's a lot of money, a couple hundred million, but a couple hundred billion difference. That extra 15 years. So, we've talked about these three things: time value of money, compounding interest, and the rule of 72. I would submit to you the two most important factors to investing, not how much money you have to invest, how much time you have to invest, and how consistent can you be with that investment. And if you can do those two things, I'm going to show you tonight how long it's going to take for you to become a millionaire. Okay? So look at this graph. If you start at the age of 20, it only takes $200 a month. That's $2,400 a year, and making an average rate of return of only 8%. Okay? If you do that until you're 65, you will be a millionaire by the time you're 65. Who here wants an extra $1 million cash, liquid, when you're 65? I do, very much so. Now look what happens when you're 55. If you start at 55, look how much you have to save on a monthly basis to do the same thing. Okay? This is probably one of my favorite tools to demonstrate the power of compounding interest, the rule of 72, and the time value of money. Time is probably the most important thing when it comes to building wealth. Okay? Any comments? Any questions so far? Does that surprise anyone? Okay. So, let's talk about one of the most powerful tools that you have available to you. Who in here has a job? Okay. Anyone here self-employed? Okay. Who here does not have access to a 401k? So we do have a few. We'll talk about that here in just a second. Also, I would submit to you that one of the most powerful tools for the average American who is employed and maybe doesn't have access to a pension, and I'll tell you this, if I went to work for a government agency and they said you have the option to either participate in a pension plan or a 401k match, I would take the 401k match all day long, every day. Okay? I would submit to you that the 401k is one of the best ways and one of the fastest ways you can get to $1 million. Unless you want to build a side hustle and grow business, that's a really good way too as well. Real estate can be, but we're not talking about that tonight. So, why? Why is a 401k one of the best ways to build wealth? Well, you get to take advantage of compounding interest. We've already talked about how that works. tax incentives. The federal government gives you tax incentives for participating in a 401k. So that means the tax drag on the growth doesn't exist. So investing in a retirement account like a 401k or an IRA versus a non-qualified brokerage account. If we made the exact same trades in both of these accounts, which one's going to grow faster? The 401k is, because you have to pay taxes on all the dollars before you contribute to a non-qualified brokerage account. You don't have to pay those taxes in a 401k if it's a traditional. If it's Roth, that's another question. And then, let's say you buy and sell and you trade and rebalance as the market changes. But if you buy and sell and change in a non-qualified brokerage account, there's going to be tax consequences and there's going to be tax bills, capital gains, either short-term or long-term capital gains you're going to be subject to. Those are bills to pay. That's money going out of that account. That's tax drag on that account. That does not exist inside of a 401k or an IRA. That in and of itself gives you all the advantage in the world to build wealth. But not only that, if you have a company that offers a matching contribution, let's say it's 3% here at the bank, they offer 7% match. So if I do 7%, the bank matches 7%, I'm getting 100% return on my money. There's nowhere in the market that I can guarantee that. Maybe it's only 3%. The 3% is kind of the industry standard, but still 3%. If you're doing 3%, the company matches 3%, it's 100% return on your money. Remember the compounding rule of 72? That's really, really important for building that wealth. Okay? And the IRS will allow you to save up to $23,500 per year. Now, maybe you're not to the point where you're saving that much, but that can be a goal. Imagine if you are saving $23,000 a year plus whatever your company matches. I call this the 401k supercharger. Okay? It's a very powerful tool.
Is that limit the same if it's not through an employer?
Maybe. Let's talk about that right now. So, if you don't have access to a 401k, you can do an IRA, an individual retirement account. The limits are less, $7,000 versus $8,000 if you're over the age of 50. Still have the same benefits, still has all the tax advantages. It's just, you're not getting any employer contributions, but you are getting all the tax incentives. Okay, and it is a little bit of a lower amount. But still, even if you're doing $7,000 per year, you have and you're young, you have a high chance of getting to $1 million, even inside of an IRA account. Okay? Now, if you're self-employed, it is now easier than it's ever been before to start a 401k for yourself. It's called a solo 401k. And instead of paying taxes that you might owe on profits that you've earned through self-employment, you can put money towards your own retirement account in a solo 401k. If you don't think you can handle the expenses of a 401k, then there's SEP IRAs, there's simple IRAs, there's all kinds of options if you're self-employed or you're working for a small business. If it's a small business and there's maybe 5, 10, 15, 20, maybe 30 employees, and they don't have access to this, have your boss come talk to me, and we can help you out. Starting any kind of an employer plan is really easy with technology and automation. It's cheaper than it's ever been, and it's faster than it's ever been. So, any other questions before we move on? And we're about halfway through.
Can you talk a little bit about the Roth?
Sure. Okay, so difference between traditional and Roth. Traditional IRA, you get tax incentives for contributing to that now. you could actually reduce your taxable income by that amount. This is above the line deduction. So that means it's a dollar for dollar deduction on your tax returns. So you get that benefit now, but then the IRS says you're going to defer those taxes all the way to age 73. That's the longest the IRS will allow you to defer those taxes for later. And then Uncle Sam says, when you turn 73, I'm going to require you to take minimum distributions for the rest of your life. And I don't know what the tax rate's going to be, but whatever it is, that's what you're going to pay. Okay? Now, in a Roth IRA, when you get your paycheck, you're getting your paycheck and you're paying all of your taxes that are due, and then you're making contributions. Okay, so you're making after-tax contributions. It grows tax-free, and then when you pull it out in the future, it's also tax-free. Okay, so the only difference is when you're paying taxes. You either pay taxes now or you pay taxes later.
When it compounds, do you pay the taxes on the compound?
On the Roth IRA?
On
No.
the,
On the traditional, you still do, because you're just deferring those to a later date.
so it just, the taxes build along with it?
Yes. You see the problem.
Oh, yeah, I see.
What about a Roth 401k? Is that an option?
Yes, most employer plans do. If they don't, you need to talk to your HR rep and say, hey, get this on our plan as soon as possible. Because it's a matter of just getting it in the plan, that's it.
I was like, I'd rather pay the taxes up front.
Exactly.
Better out back.
You're thinking smart. Anyone else?
If you have access to both like a 401k and a Roth IRA, should you focus on like investing into your own 401k, or should you prioritize like maxing out your Roth IRA and then going to 401k? Like, what would your advice be if you have access to both?
General, without knowing anything about you, I'm always going to say your goal should be maxing out a Roth 401k contribution. Your company match is going to be traditional. There is legislation on the table that could change, and you can actually, in the future, you can elect to do Roth company match, but that's going to increase your taxable income. 1099 somewhere is going to come into play, and that's going to be added. So without knowing anything, I would say your goal should be maxing out your Roth 401k contribution, then start looking elsewhere. Okay. Any other questions about traditional versus Roth? Okay. Okay, so I want to show you in a 401k, it's a race to 100,000. We talked about compounding interest. At what point do you, this first 7, if you're making 7% per year and you're saving $10,000 a year, it will take you 7.84 years to make your first $100,000. Now, this is a key pivotal point in your wealth building process, because as soon as you hit 100,000, that's when the compounding interest part of your wealth building really starts to kick in, because now the interest that you're making is helping you build wealth faster. Let me show you why. So it took us 7.84 years to make our first 100,000. The second 100,000 only takes 5.1 years, doing the exact same thing. And the only difference is interest. Your interest is now working for you. And this is going to get faster and faster. And that shows. So on this table, you look at, say, 500,000, making 7% per year, not changing anything. From that time forward, it only takes 2.5 years. And then when you get into basically this section, look how quickly you can build wealth. And over here, how fast you're getting down into this section. So that's all of these things coming together to work for you. You can see why time and how frequently it doubles becomes very important. Okay. So what can you invest in? So there's real estate. I know real estate in this area in southern Utah, we've seen some major expansion. Real estate is an amazing investment, and we have tools and things here at the bank that can help you get into that. It is a little bit of a learning curve, and it's a little bit more hands-on, but we have resources here at the bank. If you have interest in doing that, we can help you. Stocks and bonds. We can help you open a brokerage account. You can start investing money, opening an IRA account. If you're self-employed, we can help you with a 401k account. And you can start investing in mutual funds and ETFs. Are there any of these things up here that you don't know what they are and you want to talk about?
Can you explain ETF?
ETF is an exchange-traded fund. It basically gives you the diversification of a mutual fund, but it trades like a stock. So ETFs are a newer development than mutual funds. Mutual funds have been around for almost as long as the stock market has been open. ETFs have only been around for maybe the last 30 years. And now are one of the most popular investment tools. And why is it important that it trades like a stock? It's because of inside of mutual funds and inside of ETFs, they have what's called an expense ratio. So there's a money manager who is making the investment decisions, and there's a team of CFAs and other analysts that are analyzing things. It costs money to manage that money. Okay? Mutual funds trade one time a day at the close of business. What's the net asset value? What's our expenses? This is what the market value is. So the reason why mutual funds trade one time a day is because they have to calculate all of that. And they're managing it a little bit more actively. Then ETFs, they do the same thing. They get all the diversification of a mutual fund, but the way that they manage it is different. And so it allows them to charge lower expenses and make the trades a little bit differently. And so it allows you to trade like a stock throughout the trading day, which you can buy and sell multiple times throughout the trading day.
Is it riskier? You can make more or you can lose more on it?
Yeah, you can. I would say it's riskier only depending on the strategy of the ETF. Is it for growth? Is it conservative? Is it mostly bonds? There's just as many strategies and portfolio managers out there as there is options. Is just as many as stocks as you can buy. There's literally thousands of companies that you can purchase on the open market. And ETFs are just as diverse. And some of them are managed very conservatively and buying 100% in government treasuries. And some of them are buying leverage, they're borrowing money and they're buying options and hedging positions. You can get as aggressive as you want. But mutual funds are the same too. It just depends on the strategy. Okay. Okay. Index funds, they're a really cool thing. Anyone heard of the Dow Jones Industrial Average, the S&P 500, or NASDAQ 100? So these are probably the three most commonly used in the news, the three biggest notorious indexes. They are benchmarks. So first and foremost, the Dow Jones is not an investable asset. Okay, you can't go buy the Dow Jones Industrial Average. You can buy an index fund that will perform like the Dow Industrial Average. But an index fund is interesting because the S&P 500, it's a benchmark that measures the performance of the 500 largest companies in the US. You could go buy an S&P 500 index fund and you're going to get the performance of the overall stock market. You're never going to do better, you're never going to do worse, you're just going to do what the market performs. And why would you buy an index fund versus an ETF versus a mutual fund? Well, if you think a fund manager can beat the market, you're going to want to buy an ETF or a mutual fund. If you don't want to be as aggressive as the overall market, the broad market, maybe you want to buy a more conservative mutual fund or an ETF, right? So it depends on what you're trying to achieve. Now, if I'm well on my way to my financial goal and I'm 55 years old and I don't need 10% per year to hit my goal, what was my base rule at the very beginning? Don't risk what you have and need for what you don't have and you don't need. I'm not going to take as much risks when I'm 55 as I am now. If I'm 22 and I'm just starting out, I'm going to take risks because I need to build wealth. So I'm going to buy S&P 500. I'm going to buy leveraged ETFs. I'm going to buy individual stocks, and I'm going to buy options on those stocks. I'm going to take some risks.
So what's the difference in annuities?
Annuities are investment tools offered through insurance companies. So you have life insurance, which is designed to create an estate when someone dies and that estate passes on. Okay? Again, maybe you're looking to protect from taxes and you're passing something on to an heir. Life insurance can be a really amazing way to do that. But let's say you already have your money. Now you're 65, you want to retire, and you don't want to take risks in the market, and you want guaranteed income for the rest of your life. You don't know how long that is. But what you're going to do is you're going to give this money to the insurance company, which they get to use the law of large numbers. They get to bring in these kind of like the bank does with fractional reserve banking. They kind of do the same thing in the insurance world, transfer risk across large numbers. They're going to guarantee you a certain amount of income for the rest of your life. Even if you live a long time and your cash value goes to zero, they're going to continue to pay you that income benefit for the rest of your life.
What happens if you pass before you spend that money?
There's two kinds of contracts. You can either get an annuitized contract, which says, depending on how you set it up in the beginning, you either get a defined benefit for a certain amount of time, or your heirs, the insurance company could get the rest. But in a deferred annuity where you purchase an income rider, the beneficiaries will receive accumulated value minus withdrawals. What's left over, they get. So it depends on the contract. Okay. All right.
What's been the average rate of return for index funds for like the S&P lately?
So the average S&P depends on what charts you look at, but basically for the last 50 years, it's like 10%. 10% per year. So you'll double your money about every 7 years on the S&P. Okay. That's it. That's all I've got. Any more questions?